Hey traders, this is Blake Morrow with Trader Summit, and with me today I have Jim Welsh from Macro Tides. Jim, good to see you again.
Great to see you, Blake.
It must be Friday.
It is Friday. Amen.
Amen. Well, I missed you last week. We had a little scheduling conflict. This week, it's good to see you again. We just came off a jobs report. The jobs report, the headline number came in a little worse than expected, but if you dig a little deeper, it's not, and it really wasn't a bad number, was it?
No, it really wasn't. And the table is set for, I think, a blowout number for the month of October. The main point here is some people have raised the point, well, maybe the Fed won't taper or announce it at the November 3rd meeting. This number does not change that, in my opinion. Basically, the survey each month is taken the 12th of each month. Well, on September 12th, COVID Delta version was peaking. The unemployment benefits ended on September 6th, but that's a really short window. Whereas when we get into October and the October jobs number, I think you're going to see that play out a lot more. Revisions were up about 169,000. Government jobs dropped, I think, about 180. And so, and that's due to the seasonal adjustment factor, which 2 months ago, the Labor Department acknowledged, we're having trouble with that just because of the way things are going. Wage growth was very solid. So to me, it does not do anything to dissuade the Fed from going on November 3rd. And the point I would make is tapering is related to inflation. And housing prices, by the way, are up almost 20%. And rates are equated to the labor market. So the Fed wants to wait until the labor market shows much more improvement. And we're talking sometime next year. So again, this doesn't dissuade, I think, the Fed from going on November 3rd and announce the tapering.
That's a good way to look at it. As I was talking with our the Forex analytics community of traders this morning, I was talking to them about, the Fed really already outlined what they want to do. And to put it the way you just put it is it makes a lot of sense to people is that, the tapering process is going to happen.
Yes.
Wouldn't you agree that we'd have to see a couple of really bad pieces of data? And like I said, we may not have created the number of jobs that the market was expecting, but it still wasn't a horrible number. We'd have to see a couple months of really bad data for the Fed to maybe even think about pausing. Is that right?
Yeah, and it's not going to happen. I mean, You look at job openings, it's about, 10.9 million, and you have less than 8 million people unemployed. So as long as you have that dynamic at play, Blake, the underlying health of the labor market is strong. You have issues that are keeping people out. And we've talked about this. I believe there's going to be an ongoing labor shortage. You've got 2 million baby boomers who left the labor market. They're not coming back. And you've got a bunch of parents, primarily women, who are at home, taking care of kids. And until schools are fully reopened and they know they're going to stay reopened, moms are going to hang out. So those are the underlying forces that I think, the labor market is just fine.
Okay, well, let's turn our attention then over to crude oil. So crude oil, has rallied towards 80, or it actually traded up at 80 this morning. It's been obviously in a pretty bullish trend, and everybody's talking about crude oil. So do you have any thoughts on crude and where it's at and where it might be going?
Yeah, I think we're near a high, just based on sentiment. Oil's had a lot of good news. And if you look at a long-term chart going back, like 15, 20 years, there's a couple of trend lines that come in around $83. I think we're really close to a high, and I would be looking, to, if not short it, but at least say adios amigos.
Wow. Okay. Well, so you're actually quite bearish here. Is there any place that you'd be long crude oil for, even if it's for a bounce?
Again, you've got a little bit more upside. Then I think there's a pullback probably to the mid 70s, low 70s coming. Whatever the recent low was, would be the first initial level of support before you might see another bounce.
Got it. Okay. Well, I'm a couple more subjects I want to talk with you about. How about gold? Gold, we popped up today following the data. It's obviously slumped. The dollar, showed a bit of a reversal there. But gold has been pretty disappointing for a lot of bulls. And I talk to a lot of people. I do a lot of different interviews, and universally, everybody's pretty bullish gold. I can't really argue with their long-term arguments as far as the gold goes, but price action kind of paints a different story. We're gold's really struggling. So what are your thoughts on gold, and where are we going to be? Let's just say, 30 days from now and maybe 6 months from now.
Yeah. Well, a few weeks ago, we had a conversation. I thought gold was vulnerable. A couple of weeks ago, I suggested that if gold dropped to the 1720, 1730 range, it was a buy. It did. It has subsequently bounced. I think gold has a shot here, Blake, to move above 1800 and maybe pop towards 1830. One of the key points in my mind is Powell for months and months said inflation is going to be transitory. A lot of people believed him. A week ago when he testified to Congress, he didn't use the word transitory a single time. And he kind of acknowledged, the supply chain issues and inflation is likely to stay more sticky. And I think that's one of the reasons why gold dropped to that level and then subsequently rebounded. So very short term, I'm bullish. I think gold is going to go above 1800. Obviously, the stop at this point in time, I would put it, 1725, 1730, because, you got a break even trade from where I suggested buying it 2 weeks ago.
So with that being said, you can't be, or can you be bullish the dollar and bullish gold at the same time? Because we have the dollar that's right up against really key resistance at 94.50, kind of wiggled some people, out today. It slumped a little bit, it bounced back, but it's really holding up fairly well considering what's going on. So, how about if the dollar breaks higher? Are you still going to be bullish gold then? I mean, or... Oh, you won't. Okay. All right.
No, I mean, again, my take was, and we've talked about this, late May, early June, I was looking for a very significant low in the dollar, that it was ending the correction that began from the January 2017 high, a big ABC down. That implies the dollar is going above a par. Now, you brought up an important point, Blake. Near term, this area between 94.50 and 95 is really significant resistance. I think the dollar is going to pull back from this level before it ultimately punches through. So there's a window here where the dollar can pull back and the gold can then pop over 1800. But longer term, my point has been the ECB is way behind the Fed in terms of changing its monetary policy, and the euro's 57% of the dollar index. And I think that's what's been driving the dollar. And the other issues, obviously, with energy hitting the European economy, is I think why near term the euro has been weaker than one would have ordinarily expected. So again, I think you just have to play these short-term squiggles, but bigger picture, I think the dollar is going significantly higher, over 100, as long as it holds above about 91.20.
Great. Okay, so one last thing I want to talk with you about. Let's talk about yields and let's talk about rates. We've got yields moving higher. Has anything changed with your view as far as rates go? Because I know we've had some conversations in recent weeks about them. So let's hear what your take is there.
No, nothing's really changed. One of the things that we've discussed is that the lack of supply, new supply, because with the debt ceiling, the Treasury couldn't issue any new paper. The Fed's still buying 120 or 80 billion a month in terms of Treasury debt, and they were absorbing all the supply. That once we got the debt ceiling approved, and in effect we did because it got pushed back to early December, the Treasury is going to offer about 480 billion bucks of paper between now and then. So you got a lot of supply. Technically, bonds broke out above 140 on the 10-year. And again, I think it's going above the March highs at 175. So you got a combination of a lot more supply. The inflation news isn't getting better anytime soon. And I think the Fed is going to announce tapering at November 3rd.
So then, here we go. We got yields moving higher, and maybe that's the catalyst that drives us a little bit lower, at least in equities in the near term. The question might be, will the equity markets be able to absorb higher rates?
Ultimately, yes, but in the near term, it's the velocity of change in terms of rates that has an impact. When we talked 2 weeks ago, my expectation was the S&P would drop below 4306, got to 4279. On Monday in my weekly technical review, I said, look for a rally. The NASDAQ mega cap stocks, the RSI on the Qs was below 30. And the, if you will, reopening cyclical stuff looked like it could bounce back up to the September 27th high on the Russell, transports, and so forth. So I think this rally has pretty much run its course. And my expectation is we'll see the market reverse lower next week. And I think the S&P is going to go to lower lows between now and call it the end of November.
All right. Well, there it is from Mr. Jim Welsh from Macro Tides. So, Jim, I want to say from the Traders Summit community, we love reading your updates, your excerpts from your newsletters. But how do I, as a trader, get your full newsletter that you write, or your newsletters that you write throughout the course of the month? How do I get those?
Well, you can send me an email, Jim Welsh Macro @gmail, or go to macrotides.com.
Great. Well, Jim, thank you as always. It's so good to see you on a Friday. I missed our last week's meeting, so I'm glad to get the update from you this week, and I'll look forward to our next meeting next Friday.
You got it, Blake. Have a wonderful weekend.
You do the same. Thank you.